The Federal Reserve has never been so open about its plans. In the past 5 years, the US central banks introduced press conferences and begun to offer forward guidance, as well as the notorious dot plot of the forecast by each of its policymakers. Janet Yellen, Fed chair, has painstakingly spelt out the data dependence and the economic variables that are being considered by the policymakers. In return, the professional economists who are paid to interpret Miss Yellen's pronouncements really couldn't be more evenly divided. Of the 75 who submit their forecast to Bloomberg, 37 expect rates to stay flat, 37 expect rates to rise, and one, at brokerage Janney Montgomery Scott, splits the difference by predicting that the Fed will raise rates, but only by half as much as usual. Now, the focus this week will inevitably be on whether the Fed goes ahead with the much discussed hike on Thursday or decides to hold off. You can see on here how the expectations of a rate rise for this month have come down. This is showing the yield on the Fed funds future. That's now pricing in odds of less than 1 in 3 of a rise this month. You can see that a rise by this point was absolutely beyond certain, and that back in 2013 at the peak of the taper tantrum, people thought that rates by now would have risen really very far indeed. Now, on a simplistic interpretation, a rate hike would mean a stronger dollar and higher bond yields. Warnings abound from institutions like the IMF and World Bank about the danger that this would pose to emerging markets. A more realistic interpretation might point out that the dollar weakened throughout 1994 as the Fed hiked, that it rallied through the 2000 to 2002 rate cuts, and that long bond yields famously fell during the rate rises of the second half of the 2000s, when the dollar went up and down, but overall was unchanged. Now, this introduces yet another uncertainty. Not only don't we know what the Fed will do, but we don't know what the effect of its actions will be, whatever they turn out to be. Still, here are some things that the market thinks that it does know. First of all, tighter policies on the way. If not this week, then soon. These red and blue lines show how unemployment's come down recently, with even the broadest measure, known as U6, this measure here, back down to levels where in 1994 rate hikes had already begun. Although, I should say, it's still very slightly above where it stood in 2004 when the Fed began to hike. But the headline unemployment measures now approaching 5%, level which is usually hit long after the Fed's already started its hiking cycle. Now, down at the bottom here, this orange line, these two are on this axis, the unemployment measures over on the other axis. So this orange line here shows the rate-sensitive 2-year bond yield, and you can see it's done pretty much what it should. It's begun to price in some action by the Fed. That's up a fair bit. Although we should say, of course, the Fed funds rate itself, this green line, remains steadfastly on the floor. Now, this gap that's opened up doesn't guarantee that a rise is on the way. It can be horribly wrong. Of course, it was throughout this period when the 2-year bond yield during 2009, 2010 said that a rate rise was on the way and that the Fed funds rate was only temporarily depressed. That turned out to be something that's now lasted for 7 years. But it does at least, this idea that there's going to be a hike, maybe a few hikes over the next couple of years, does at least fit with the figures on unemployment coming down. Of course, against that, inflation remains well below target, and there's little sign in the bond markets that inflation's expected to appear any time in the future. Furthermore, all the chaos that we've had in the markets the past couple of months is likely to give Fed policymakers pause for thought, at the very least. The result is that even those predicting Fed action think that the Fed will carry out what's being dubbed a dovish hike, raising rates but talking down the expectations for future rate rises. Those expectations remain far more important for the path of asset prices than whether rates are finally lifted from the floor. As with so much of the Fed's job over the past few years, what the Fed says about the path of future rates on Thursday will be at least as important to markets as what it actually does.